So now let's talk about depreciation. We all heard the word depreciation before, and I'm assuming that you can sense the meaning of depreciation is that something loses value over time. So formally, we just say that over time, fixed assets, with the exception of land, lose their ability to provide services. So I want you to remember that land is the only fixed asset or long-term asset or property, plant, and equipment that never loses value. And this is something special about land. Land improvements is different. Land improvement can lose value over time. So the cost of fixed assets such as equipment and buildings should be recorded as an expense over their useful lives. Recording the cost of fixed assets as an expense is called depreciation. Because land has an ultimate life, it's not depreciated. And that tells us something about the value of land. So depreciation can be caused by physical or functional factors. So speaking about physical depreciation, in this case the factors include wear and tear during use or from exposure to weather. So something like using my bicycle or using a car. This is something that physically depreciates over time. On the other side, we have functional depreciation, and I think computers can be a good example. So functional depreciation factors include obsolescence and changes in customer needs that cause the asset to no longer provide services for which it was intended. I still have a computer that's 10 years old, but honestly I can tell you that even though it works, it starts and everything runs, but it's not really functional because it cannot do the things I expected or expect to see from a computer. So two common misunderstandings that exist about depreciation, and we need to be aware of these misunderstandings to avoid them. One of these misunderstandings is that depreciation does not measure a decline in the market value of fixed asset. So depreciation does not measure a decline in the market value. So even if the market value goes down or goes up, that has nothing to do with depreciation. So depreciation is an allocation of fixed assets cost to expense over the asset's useful life. And I want you to remember that. It's an allocation of the fixed assets cost to expense over the asset's useful life. Therefore, the book value of a fixed asset, which is the cost less the accumulated depreciation, usually does not agree with the asset's market value. The other kind of misconception is depreciation does not provide cash to replace fixed assets as they wear out. Many people think, oh, depreciation is like putting aside some cash so we can replace this asset in the future. And that's far from being true. So that's not something that we have to think about when it comes to depreciation. The three factors that determine the depreciation expense for a fixed asset are the initial cost, or in other words, the historical cost of that fixed asset, the asset's expected useful life, or how long we expect that asset to survive or be in operation. And the third thing is the estimated residual value, which is how much we expect to sell it for. The residual value, sometimes we call it scrap value. I just want you also to notice that one of these are factual. So the initial cost is something that we know, it's fact. The other two variables or factors are estimates. So you see that we estimate the useful life and we also estimate the residual value or the scrap value. So that's why depreciation is something that's a little bit subjective, because when we estimate things, sometimes it's not very accurate. One accountant might estimate it one way, the other accountant might estimate it in a different way. So what is the initial cost? The initial cost of fixed asset is the purchase price of the asset plus all costs to obtain and make it ready for use. I like to call it the historical cost of that fixed asset, how much we paid for it to acquire it. The expected useful life of a fixed asset is the estimated length of time the asset would be used in normal operations. Again, it's an estimate, it's expected. So it's estimated at the time the asset is placed in service. Estimates of expected useful lives are available from industry trade associations. However, again, it depends on manager's judgment in some cases. The residual value of a fixed asset is the estimated value of the asset at the end of its useful life, or how much we can sell it for. So as I said, we call it sometimes scrap value, salvage value, trade-in value, and again, it's an estimate at the time the asset is placed into service. The difference between a fixed asset's initial cost and its residual value is called the asset's depreciable cost, or how much it can lose in value over its useful life. So this is the asset's cost that is allocated over its useful life as depreciation expense. If a fixed asset has no residual value, then its entire cost should be allocated to depreciation. And again, this makes our life easier because we don't really need to worry too much about the residual value if the residual value is 0. So in this case, we just see how much is its cost and divide it by its useful life, and we get the depreciation expense or cost every period. So let's see this example. Assume X company purchases a new forklift on January 1st that has an initial cost of $24,000, its expected useful life is 5 years, and its estimated residual value is $2,000. So in this case here, we can see that the initial cost is $24,000. We deduct the residual value or the scrap value or the trade-in value, and that will give us $22,000, which is the depreciable cost. These $22,000 are going to be allocated over these 5 years. So year 1, year 2, year 3, 4, and 5. We'll see different approaches of allocating the $22,000 over the 5 years. One of the easiest ways is what we call the straight line method, and we'll see that as one of the first methods that we're going to be explaining. And in this case, since it's straight line, all the years are going to have the exact same value. Then we have different methods. We call them unit of activity methods and double declining balance method, which is referred to as the accelerated method. These methods, they have different way of allocating the exact same $22,000. So one thing I just want you to know is that the $22,000, whatever the method we're going to use for depreciation, they are going to be allocated over the 5 years. In total, the value should be equal. So it doesn't matter whether we go straight line, accelerated, or units of production. It's not going to be different at the very end of the day. So the 3 depreciation methods used most often are the straight line depreciation, the units of activity depreciation, sometimes referred to as units of production depreciation, and then we have the double declining balance depreciation method, which is also referred to as an accelerated depreciation method. The reason they say it's accelerated because it starts by depreciating a big chunk of the value of the asset in the earlier years, and then it slows down by the ending life of the asset. It's not necessary for a company to use only one method of computing depreciation for all of its fixed assets. So we can see that companies can use different methods from one asset to another. So let me stop here, and the next video I'm going to be going over these 3 methods, and we'll see the differences and how they can be calculated, and we'll also see the journal entry for recording depreciation.